which is a satisfactory measure of the liquidity ratio. Right? So you know how to measure the liquidity ratio, current assets divided by current liabilities. So usually the industry average, usually the normal conclusion would be 1 is better. Right? 1 is better means, right? So the usual conclusion is the final answer as 1 is better for the liquidity ratio. That means current assets, right, divided by current liabilities equal 1 is, if you get answer 1, that is the normal level to maintain, right? So what if the ratio is higher than 1 or lesser than 1? What would be the consequence? Can you be satisfactory if the ratio is lesser than 1? If the ratio is lesser than 1, will it be satisfactory or not? If the ratio is higher than 1, right? So what is the best measure of the liquidity ratio is also decided by length of the working capital. Decided by the length of the working capital. If the working capital cycle is negative, ratio less than 1 is perfectly fine. Okay, if the cycle is negative, the best example is what we have faced in recent past. Let's say that you are selling milk powder. Okay, you have a big inventory of milk powder. So the demand went so high and all the inventory was over. What happened next? You have got so many orders. People have paid for you for the product that still you haven't got into your store. Right? They don't have stocks. But people pay for their orders. So then without even selling product, you get money. Right? So that is a classic example where the working capital cycle becomes negative. So in that case, even a ratio less than 1 is perfectly fine because you have got the money even before selling the product. So that much of too much of liquid, right? If the inventories are too much of liquid, so then having a ratio less than 1, even negative would be okay. So you have to find the exact reason why the ratio is going down. Think about retail industry. Think about construction industry, right? So if you take construction industry, always ratio of 1 or more than 1 is better. But retail industry, it is not exactly the same. So you don't know the nature of demand for the products, inventories, right? If there is high demand, they might have negative working capital cycle, which cause you to have liquidity ratio lesser than 1, but that should be perfectly fine. Okay, but if you take the construction industry, if they have a liquidity ratio lesser than 1, that is not a good signal. Okay, so just blindly you can't say the company is having liquidity problems because the liquidity ratio is less than 1. Then your answer is wrong. So you have to carefully look into the industry, to the inventory, and what is happening around, maybe macroeconomic environment, right? Looking at all these things only, you can come to the conclusion what is a satisfactory measure for a particular liquidity ratio. Be very cautious about comparing the liquidity ratio of one entity with that of another, unless we are sure they operate in a similar sector. Right? So you cannot compare the retail sector liquidity ratios with construction sector liquidity ratios. That's what basically it means. When comparing the liquidity ratio of an entity from one period to another, it is a sudden variation in the ratio compared with the longer term trend that should be our focus. Right? So here what mentioned is about the variation. If there is a sudden variation in the ratio, in the long term, then that can become a concern. If there is a sudden variation, right? Not whether the liquidity ratio is lesser than 1 or higher than 1, but look at the variation over some time period, some considered time period. Look at the variation. Then you can come to a better understanding about the liquidity position. Okay, right.